Well, hello everyone. Thank you for joining our webinar. We are going to wait till 11:03 Pacific, let the last 20% or so get in, and we'll get started in 2 minutes. Thanks. Well, all right, we're going to go ahead and get started. I want to thank everybody for joining our webinar titled "The Great Inflation versus 2024," and wanted to go through. We want to go through a couple tools that we're pushing out to our client base to kind of handle some of the liquidity challenges that in some of the current market challenges that exist right now. We've got a lot to cover. We're gonna jump right into it. My name is Phil Rasori, Chief Operating Officer of MCT, and we've also got Andrew Rhodes, who is our Director of Trading at MCT. And again, for the clients on the line of MCT, some of this will be review, but there'll also be some new material here as well. Just to go through the agenda, we'll go through kind of the current lay of the land in the MBS market. Andrew's going to compare, as the title would suggest of the webinar, he's going to compare to the historical precedent of the great inflation period in the early 80s. And I would caveat, as Andrew will caveat, we are not going to pretend to be economists here. We're gonna a lot of this will be stating the obvious, but what we will be doing is connecting these kind of these issues to the issues that you guys are all dealing with on a day-to-day basis with regards to coupon illiquidity, especially premium coupon illiquidity as we transition coupons. We'll talk about kind of where we feel MCT's place is here as the market transitions, and our continued support for our clients with regards to future webinars. And then what we're really excited to talk about is kind of some of the solutions that we've been working on for the past year, to provide the market with some tools to handle some of this illiquidity that exists in these premium coupons. And then also talk a little bit about something that we've rolled out just recently in partnership with Agile Trading Technologies, to an initiative to enhance outer month liquidity. And when we're talking about that, we're talking about the settlement months past the back month, what we call that third settlement month that exists on screens today. So Andrew's going to talk a little bit about that, and then we'll go through what we see moving forward, and some of the changes that are going to come down the pipe, and new innovations as well. And if we have some time at the end, we will go through. We'll do some Q&A if there's any questions. So to jump right into it, basically we just Andrew just took a Bloomberg screenshot here, and really, if you think of 2023, and we think of the first half of 2023, it was no picnic there. But if you just look at this screenshot, and I know the numbers are kind of hard, but we think of a Fannie 6, or we look at a Fannie 6 here, and the fact that it was in the realm of 101 to 102 in the beginning of the year is an entirely different world, right, than we are now. And so obviously things substantially deteriorated into at the end of Q3, beginning of Q4, and then have turned back around. But the point is, as we go through some of this, is that's really the cause of a lot of our issues that exist on the capital market side, is this transitioning of coupons, as you see, as if we look at this graph, the UM36 was really a market coupon with enough premium in it back in the kind of first half of the year to sustain par pricing. And that we went from that from 101 to 102 into the doldrums there in October, below 97. And I should say that when myself and Andrew and our chief marketing officer Ian Miller we were talking about a potential for this webinar, it happened to be in the third week of October, and we talked about how we have to be obviously ready for the market to do anything. If we all, everyone on the line here, if we all think about where we were just basically just 3.5 weeks ago, you're sitting at basically a 506 on the 10-year. Anyone would have thought that 3 weeks later, we'd be almost 60 basis points lower in rate. So it just shows you that, no matter where you're sure the market's going to go, you're more than likely not going to be right. But so obviously the market's come back in the last few weeks, but as you can see from this graph, we have a long way to go from just getting back to where we were in the beginning of this year, let alone earlier time. So again, specific to, like I said earlier, I wanted to talk specifically about you know the issues that we're dealing with on the in the mortgage-backed security world, and which of course affect us, not specifically the 10-year treasury. We've said this on other webinars, but I think this is a good graph to show basically the run rate that we're on right now. This is the Fed's balance sheet of MBS. We are on, they've come down. It actually, the last couple weeks were actually pretty good progress. I think their balance sheet showed that it came down about 40 billion in the last, which is the biggest move we've seen since they started runoff September of last year. But you can see that we shoot up in 2020, and then it just progressively just launches all the way into middle of basically May of 2022. Where at that point the Fed caps out and just replaces runoff, and then they begin to not replace runoff starting in middle of September last year, and then we finally start to see this decline. As most everyone knows, the Fed's made it very clear that long term they do not want to hold mortgage-backed securities, unlike treasuries, in their balance sheet. And so what that would suggest, if you believe them, if you take them at their word, we've got to get this from September 15th in 2022 at 2.7 trillion down to zero. So if we just look at the run rate that we've got right now, we're on basically a little over a 10-year run rate. And the reason I say that is for basically ever since that was, I guess, November 25th, 2008, the starting of QE, for those 14 years, we've had the Fed at a positive participant. We really only had them at a neutral participant for about 4 months. You can see that here in the graph, right? You can see from basically May to September, they're a neutral participant. Now, of course, they're a negative participant. And so that's going to continue regardless of what happens with mortgage, with rates in general. That's going to continue to be a drag on TBA liquidity and cause pressure between mortgages and treasuries. This is very, apologize for the simplicity of this graph here. This just goes, we'll skip right over this, but it shows the CPI of the past 5 years. Look, obviously that is what caused, the inflation, caused the Fed to finally turn around. And you can see it peaked, and really there's been some very recent good news, a little conflicting. I think late last week we had some, I think it was University of Michigan came out with some higher than expected inflation expectations, and this week we got better than expected with zero month-over-month inflation. So that's definitely good, and definitely headed in the right direction, which is good news there. Obviously, and again, these are a lot of, like I had prefaced these slides with, a lot of this is stating the obvious, but we definitely have some some external pressures, right? This is just graphs of showing just issuance, and so if you have a dramatic supply holding demand constant, let alone demand going down, you're gonna have price going down, yield going up, right? And so there is a lot of and you guys have seen all that in the news about supply. So that definitely can and will be a increase in the macro environment on rates. Again, we want to focus in general on specifically what's occurring here in our sliver of the market that we live in. And so this is our year over year lock indices, and this is a trailing 10-day moving average of locks. And really what you can see here is actually when you look year over year, we're actually not much under where we were. We're probably only about 6 or 7% under where we were a year ago in total locks. And you can see that actually, as of now, rate terms, cash outs, purchases have all kind of coalesced around the same number. You can see that you see big swings, big moves, and intra-year, and that really is just a function of we're reversing out not a strong number, right? So where we were in Q4 2022 is basically about where we are now. And one thing I think it's important to realize though is we have seen a relatively reactive refi environment, very short-lived, don't get me wrong, but in Q1 when we had a little bit of a rally, you can see lock activity come back. And so currently, with the current rates holding steady as of today, we would expect to see a little bit of a drift back upwards in volume as compared year over year. So getting back to the specifics here of what we're all dealing with in the capital markets of the mortgage industry is, when we've had premium pricing issues basically since really starting at the beginning of 2022, as the market as rates began to take off, that was really independent of Fed participation. Then when the Fed basically became a neutral, and as I said earlier, a negative participant, allowing runoff, just caused these issues to get worse. So what I wanted to talk about here is basically looking at a premium coupon. And so when as soon as you get over 101 in the coupon stack, especially as we transition coupon, so as the market moves, and what I wanted to look at is the 60 days between end of August and end of October, where the market really peeled off. And what you're going to see, what we saw there, if we just look at the 7 coupon, at the end of August, the 7 coupon was the premium coupon, and it had a horrendous bid offer spread of 20-30 seconds, what basically represents about 5/8 of a point. Normally, this spread should be a couple 30 seconds. Again, for a market coupon, a dominantly traded coupon, that spread should be inside of 1/32. And for those that don't trade TBAs, a 30-second is 3.125 basis points. But so basically with a 5/8 of a point spread, that's really an untenable cost on the premium coupon. Then when we move to, if we look basically 60 days later, the market has deteriorated such that we've moved basically 50 basis points in rate. So now that 7 coupon has become the 6.5 coupon. And you can see by the upper in the graph in the upper right hand corner there, the 6.5 coupon is substantially, more, is traded in substantially more volume, and end of August. But by end of October, the 7 coupon has now basically become the market coupon. Now, this is not the case anymore, right? Because we've now turned back around in rates. But the problem is that we now have, that we eventually got the 7 coupon to be liquid, where the spread now became 2.5 30 seconds on the, and this is on the electronic trading screens. But then now your premium coupon's a 7.5 coupon. And even in October 30th, when we're talking about, 5% 10-year, we still can't even get reliable electronic screens on the 7.5 coupon. So the point here is that we're going to continue to have illiquidity issues on outside coupons, just in general, right? Because there's no buyer of last resort. The Fed's not going to be there. But the problem is that this issue is exacerbated as we continue to transition coupons. And so it really causes an issue for front end pricing. It causes an issue for trying to figure out where your execution is, and so that's kind of setting up that kind of backdrop for some of the tools that we're going to talk about here in about in later on here in the webinar. So with that kind of backdrop of where we are now, I wanted to turn it over to Andrew, and he can take us through kind of a little comparison, which is the title of this this webinar, to the comparison to some historical precedent in the early 80s of the period that's called the Great Inflation.
Cool. Yeah, thank you, Phil. Yeah, please feel free to hop in if I gloss over anything, or if there's anything you want to point out. I put something together for the traders. Probably it was right after the conference out in Philly, and just wanted to talk to them and kind of let them know, it's essentially what they're living through right now, which is, in a historic time in the mortgage industry, and just to draw some parallels to what the kind of other periods have kind of looked like. So I did an analysis, kind of just doing some comparison back to the Great Inflation period of when we had the largest mortgage to treasury spread. And just wanted to kind of show them that in the current environment, I think over the last year, we've seen a similar spike in just the velocity of the change in the mortgage to treasury rate that we saw back in the 80s. So I have a graph of that I'll spend a little bit of time on, but we'll also be sending out the slide deck, I'm sure. So if you guys miss anything, I'm sure it will be there handy for you after this call. So but anyways, looking at the graph right here, you can see in the right around the mid 80s, about right around 86, there's a mortgage to treasury spread that was showing 257 basis points, based off of this mortgage index from Bloomberg and the 10-year yield. So the interesting thing about that is, so if you track back to the beginning of, I call it 86 to the middle of 86, there's about 170 basis point increase in the mortgage to treasury spread. And then if we fast forward to the current environment that we're living through, you see that spread go from I think it was 2021 up to close to the end of 20 or the middle of 2022. We're seeing that spread increase about 155 basis points. So that right there, that spread, that velocity of the change between those two periods are the two largest spikes that we've ever seen in the mortgage to treasury spread. And why that's relevant is the just kind of trying to figure out exactly how that looks forward for us after we're kind of going through a historical event like that. So you can see back in the mid 80s, it was a pretty quick drop off in the spread. So you get your rates back down based off of where the Treasury was trading. So that's going off the back of the highest Fed funds rate that we had back in the early 80s, which I think topped off close to 20. And then so that mortgage to treasury spread pretty much collapsed right after it hit its peak. So it was a pretty quick inflection that was in the mid 80s. But then what we're seeing right now in this environment is that we're seeing a sustained spread kind of stick around, and trying to figure out and talking to the traders on why that would be. And there's just a bunch of reasons, some that Phil already mentioned in the terms of the Fed leaving their letting the mortgage business run off. I think a 10-year run rate doesn't really provide me good feelings about how the mortgage treasury spread is going to maintain over that period of time. But I do think that we will see continued pressure, keeping rates a little bit higher. Just given that, I don't think there's going to be any, I don't think anybody's talking about the Fed actively selling off that position, but definitely something that we're keeping ears out for to see if that will ever happen, but doubt that's going to be the case. So it really is just trying to define what's going to happen here in the next in our near future, and trying to figure out exactly how that looks. So with I think with the rapid rise in the interest rates, rapid rise in the Fed funds rate, that's just caused natural pressure to push mortgage rates higher and higher, and that's essentially added on to the whole problem with the mortgage origination market, that affordability and the lack of supply. I think lack of supply is also attributed to where the mortgage rates are at. I think if we were in a kind of a better rate environment, there could be more lateral movement in terms of people getting out of houses and moving around. However, just not seeing a lot of that happen in the current environment, which makes sense with rates in the mid 7s. So I think some of the differences, and that we've kind of already gone over, is just the reason, trying to figure out the reasons of or explaining the reasons of why that spread is going to be sticking around for a longer period of time. And I think as the U.S. continues to issue more and more debt, that's just putting more pressure on that spread. And then I think the lack of liquidity on the higher end, which hopefully we've seen, I'm not going to say come to an end, but hopefully we're going to see that trend slow down as the Fed's kind of made it, not to say made it clear, but I think they're near their terminal, if not a quarter off of it. So I think if we could stick around here, then that gives me hope that we're not going to be trading the 8 coupons in the near future. But like Phil said, so you think you might know where the market's going, and the next thing you know, 3 weeks later, it could be a completely different market. But I think with where we're at, I think that does kind of provide some more. I think it does provide some more certainty for investors to step back into the market. to start buying the 6.5 and the 7 coupons, getting more liquid. I think we're definitely seeing a lot more liquidity in that 7 coupon than we were seeing a month ago, which makes sense. It's just a natural progression of liquidity. You need the product in order to create the security, and then that's kind of what drives the future price of it. So I think we're still looking to see exactly what is going to happen with the 7.5 and the 8 coupon if we ever do get up there. But I think that we're kind of hitting a high spot. I think in the rates, and hopefully, like I said, hopefully we continue to either stabilize here or start to come down. But it's all kind of dependent on what happens in the market. As we all have heard from the Fed, they're going to be data dependent, and I'm sure they're going to have some dry powder for that additional quarter point that they're going to continue to talk about to kind of drive the narrative from their side of just being data dependent. You want to go to the next slide, Phil? As I was talking about with the 10-year runoff that Phil was talking about, the mortgage to treasury spread could compress, but there's reasons for it not to compress. I think naturally it will come in line, and I think that the market will be able to absorb that the mortgage runoff from the Fed, and we will see that kind of create some natural compression, but who really knows in this environment? I think the more that we're seeing, just kind of the more liquidity that we're starting to see in those higher coupons, I think that is going to kind of provide us with a better spot to get some premium pricing. Hopefully, if we could stay sideways in this market, then at least we'll have the 7s out there that will be a liquid coupon that will be able to provide that premium pricing out there, which hopefully spurs up some activity. I think the winter months ahead are not looking great, so if we could have some kind of cushion in there, I think that will provide some more stability to the market, and hopefully, like I said, spur up some more originations. But yeah, I think the last bullet point there pretty much states it. We're not out of the woods yet, and we're gonna gotta keep an eye on the market and see exactly how it goes.
Well, thank you, Andrew. That was great. Great overview there of the comparison, and I think does justice to the title of the webinar. So, one thing we wanted to go through is we've had a lot of questions just as the market deteriorated, especially in this piece. I'm bringing this slide back up, especially in this kind of right. I would say the kind of the right third of this where the market really deteriorated from August to October. We did have some questions by clients and just market participants in general, that saying that, hey, in big market moves, MCTs kind of known for doing webinars that are valuable to the clients, which we've done, but also to the overall broader market. And I think that just going back to, and I'm sorry for flipping back and forth on slides here, but if we just go back to this graph, you can see that it was a big move, but it was over a long period of time. To look at the full 450 basis point move on 6s, it took you really had to go back about 5 months, and the 2-month period we did lose about 300 basis points into the third week of October, and I would just say, kind of going back to some of these questions, we would have had we continued to deteriorate from there with regards to the market, we would have definitely come out with with some specific webinars, and obviously market flashes to our client bases, and just with respect to a big market tank like that, some of the things that obviously you need to be thinking about are obviously it's not an MCT webinar if we don't talk about the benefits of AOTs. Those benefits are obvious when you talk about bid offer spreads, and you talk about that savings that you're that market friction that you're getting rid of when you don't have to pair out of that security. But there's also another benefit in normal markets, or either rallying markets or normal markets where you have normal rolls. And in general, that means that your TBA securities will be out of the money. So the advantage is you can wipe out that that value, that cash value transaction at the settlement, and kind of incorporate that into the price of the, yet you move those two cash flows into one. That becomes even more essential in a period where the market, and let's just pretend for a second that third week of October, the market didn't do what it did and it continued to decline. It's kind of like you're selling your house and bringing a check to the bank to sell your house. When you sell loans, obviously you're wiring, because when you're selling loans at 95, 96, and that in those instances it's below what you've got at the warehouse line. So it becomes almost existential from a cash standpoint that you have to do those assignments, and because you have these extremely juicy trades on the other side, right? That could potentially be 30, 60, 90 days out, that you need to bring forward into that loan transaction, so you don't have to wire that money to the line, and to pay for those substantially discounted loan values. So that would be one that we would have come up with had the market continue to deteriorate. But again, the kind of the current the current slog in market movement just kind of creates fewer, I guess I would say less need for a market-based emergency webinar. But with that said, we definitely want to go into some of the tools that are absolutely, we think essential in the current market. And again, I'm going to bring up this slide again, and then I'm going to transition it over to Andrew, and he can talk through this electronic indication tool that we have. But basically, I talked about how the 7 coupon transitioned from the premium coupon in end of August to basically the market coupon end of October. And while it was, it got a lot more efficient, moving from a ridiculous 5/8 of a point bid offer spread to a bid offer spread that was much more similar to a normal market coupon. The next coupon up, which was really basically going to be the next in vogue coupon, which at that kind of 2-to-1 price to rate multiple that you see up there, would have been in the 102 range. That wasn't even on electronic screens, any of the electronic screens. And so it was essential for that was very problematic, right? It's essential to get a good idea of what that's trading for if you're trying to set your rate sheet, especially if you're a Ginnie securitizer, or you securitize with one of the agencies. You have to get a good idea of where those securities are trading. And same way when you're selling loans, you want to make sure that the the buyer is actually giving you a correct value for that, for that indication price, especially if you're going to do an AOT into that, right? That the security indication price becomes essential. And so, well, kind of in the face of this, over the last year, we have been developing a process flow through in partnership with Agile Trading Technologies. Andrew, why don't you take us through kind of some of the use cases that you see for you and your 25 traders and all of the clients that you manage on where the benefits are of this?
Yeah, no, I mean, I think the benefits of just having this functionality are clear when you go out there and take a look at those illiquid coupons. I mean, I've looked at a couple different sources trying to figure out where the 7.5s are trading, and really there's no real way to get the true price of what's out in the market. So from a price discovery standpoint on an electronic trading platform, it doesn't really exist without putting a bid out there and then just denying it. But that doesn't do any favors for you or for the dealers. So having this functionality to where you're able to put out a bid and kind of just or request an indication on where something's trading, just allows the traders to be more efficient in what they do. I mean, you could always pick up the phone and call a broker dealer and say, hey, where are you seeing the 7.5s trading at right now? Which is, it's the way it's always been done, but this just allows you kind of a more fluid electronic platform to be able to provide that color back. And it's kind of interesting. I was just looking at some of our numbers for traded volume, going back September, October, and current for November. And we definitely are seeing a transition. Back in September, we were, call it 41, 43% on the 6 and 6.5s. Going into October, we were 52% in the 6.5s and about 15% in the 7s, which was non-existent the prior month. And then currently, so far in November, we're right around 17% on the 7s. So I think even with the 7s in the current market, they're definitely becoming more liquid, as I was talking about before. But I think that it's also good to make sure that you're out there and you're getting getting appropriate levels for these securities, because it is it is kind of a wider market, especially on the Ginny side. I mean, if you're looking at the mid to back month roll, you're seeing a pretty wide drop. And is that true to where the market's at? That's where it'd be good to go out and say, hey, can I get an indication on a jumbo 7 in January, and let's see where we're at. So like I said, I think this does provide some good insight into how to manage your interest rate position with what you're currently originating on the front end. And yeah, to Phil's point, being able to kind of use that, use this indication functionality to be able to kind of look at your front end pricing, seeing how you're needed to modify your front end pricing in order to make sure that you could maintain that profitability. Because if you're looking at, let's say, call it a front to mid roll of, call it 8 ticks, and then a mid to back roll of 16 ticks, you got to make sure your pricing is appropriate on that on the rate sheet. Because if you're just pricing in, a couple, call it 2.5 basis points for your entire stack, then you're mispricing the market. You're hoping that your 45 to 60 day lock, that the spreads are going to compress by the time you go to sell that, but you're really not taking that. You should be taking that into consideration on your front end pricing, right? You should price to where the market's at, not to where you expect the market to be. I think you're just kind of taking a guess there. You could do it, but the more conservative route would be to kind of to make sure that you're managing those data points appropriately. So I think just having the tools available here help you manage the position better and manage your overall profitability better.
Yeah, and Andrew brings up a great point there. I I focused on the coupon aspect, right? The fact that a 7.5 coupon, isn't liquid out there. But Andrew brings up a great point on the settlement month, right? You can have very good, you can have very good mid-month execution, and then as soon as you get into the back month, and we'll talk about the fourth month that we're bringing to market in a second here, but when you, like Andrew said, if you have that substantially differentiated roll on the screen, even if it's a coupon that on a certain month is traded efficiently, getting an indication of where that back month actually executes is important. And so just going through the specifics here, you request it, you select your dealer, your participating dealer. Not all dealers are participating in this. Obviously, it's a kind of a favor that they're doing for their clients. But you submit it, and then it's gonna come back with the timestamp. These are not, to be clear, these are indications, right? The dealer is not on the hook to, the dealer is not on the hook to execute at this price. Obviously, by definition, if you're sending this indication, it's kind of a broken market in that security, right? If you don't have good screen pricing somewhere and you're sending this, or you don't have a good idea or an efficient bid offer spread, and so you're sending this, it's just an indication of what they're getting. But these participating dealers are doing their best to actually get you an indication of where this thing is actually trading versus where it's showing. So that and we'll talk about some future use cases for it. So right now, again, the use cases that we see right now is on the rate sheet generation process, which we've just deployed this. And then also on the loan sale process, and just getting an idea of where the where the bid price execution has moved as you've priced your loans, or as you've had your loans priced on our marketplace versus where they're gonna actually execute. The indication pricing becomes very important there. And actually, we've got a couple questions that have come up, but one actually segues us really well into the other tool of outer month liquidity. And Kelly has asked, we have some builders looking at doing more forward commitments. Are you seeing more of these? And I'll let Andrew answer that question. But just in general, to Kelly's question, just at the MBA annual conference in Philly, we were surprised at how many smaller builders are apparently looking for this. And of course, if you think about just as something as a short as a 90-day exposure, for those of you that trade TBAs normally, that we have 3 months. So if we sit here for Class A, we're through November Class A. So we have December front, January mid, and February back month. Now the issue is that if we think of 90 days, even though we have 3 months, we really only have 90 days when we actually transition over. This is a good time of the month because we almost have 90 days going out to, let's call it, for, I don't know the actual notification date, but let's call it February 11th. That's going to be that's going to be, what's that, 85 days, using that as an example of exposure that you can hedge actually on the 3rd month screen. Now, if you think about as we get right to notification date of December, we're still going to have the exact same 3 securities to trade: December, January, February. So we're going to be down now to, let's call it 62 days. So you can see that you're going to basically average out between 60 and 90 long, the average is you're going to, over time, you're going to get 75 days of exposure when you hedge the back month. You won't get the full 90 days. So it's something for just something to understand as we go into the value here of 4th month. And Andrew, I'm not going to steal your thunder as much on this one. Maybe you can go through what we're doing here.
Yeah, well, I think just to answer Kelly's question is, yes, we are hearing a lot more of that and seeing a lot more of that. And we started this build out on the 4th month. I mean, this is probably going back over a year of just trying to see how we could provide more liquidity in the market to our lenders and to people looking to do these longer contracts, because I think anything outside of I think right now the cap is about 120 days that most investors are kind of willing to go, and then after that it's kind of a hard cutoff. But for this 4th month, I think this does kind of provide some flexibility in terms of being able to take out a longer dated hedge position, and then be able to utilize both together if you wanted to do something in combination to kind of get you to that longer dated expiration for those locks. We've actually got a lot of good hearing a lot of good feedback from the dealers on this. There are some additional components that come into play with going out a little bit further in settlement. An increased net worth is usually going to be looked at by the broker dealers that are offering this as an option, because they just want to make sure that you're going to be there. If they set something out for 4 months, 6 months, 9 months, they want to make sure that there's going to be the counterparty is going to be there at the end of the day. Some other requirements that we've been hearing for some broker dealers is some kind of additional margin component, and that's just in order to kind of make them comfortable with being able to take that risk position. I think a lot of dealers are comfortable with the 3-month window that they have out right now, because that's kind of the allotted time frame of risk that they've all been looking at. So I think hopefully, looking out further, we could get them more comfortable with kind of taking on more exposure. There is from a time standpoint, and there are some dealers out there right now that are already looking at offering 6-month TBAs and 9-month TBAs. So that's where that's if you're really kind of looking to go further out, having a conversation with those dealers would definitely be beneficial in terms of kind of doing those if you have a builder contract that wants to go out longer than that. So I think the fact that we're able to provide this liquidity in the system is going to be big for a lot of our lenders. There's ways that you'd be able to utilize the 4th month, and then essentially have some loans flow through that prior to AOT in that trade. So essentially effectively hedging the loan sales with the new production coming in, and then assigning that trade after you've kind of minimized that bid-ask spread anyways. So just added efficiency to the overall hedge platform. But from a capital market standpoint, I think having the capacity to have this in your arsenal to do a trade further out just kind of makes the capital market environment more and more efficient, truthfully. So it definitely helps you to set a price in terms of what you're looking for on those longer dated locks. So if you wanted to do something longer dated, you'd already be confident in what that price point is. If you're doing something from a rate perspective, you'd be able to manage to that price appropriately. So it really is kind of setting up the future of kind of providing more liquidity out in future months. And I think the way that I envision this is that hopefully we get to a point where we're able to trade, call it 5 or 6 months out for all those lenders that need that additional capacity. It's not going to be right for everybody, but it's going to be right for those people that need to have that flexibility. So I think having the capacity to have that, like I said, in your arsenal, it just makes the capital market side that much more efficient. And with that efficiencies, you're able to manage your profitability a lot better as well. So at the end of the day, it just comes down to being able to have that understanding and the knowledge of what price points you're setting and being able to manage your profitability to those levels. Bill?
And that was great, Andrew. And I just wanted to add, this is a real healthy ad for really a healthy market. Just with regards to dealers and lenders. Dealers are looking. Andrew mentioned increased net worth requirements potentially for some dealers. Managing their exposure differently as they go out in settlement past the traditional settlement months, and also potentially some margin there. And if you think about it as a lender, what's happening there is the dealer is now taking on that risk, that uncertainty. They're always taking on risk with you when they give you a credit line, right? So there's always going to be credit risk associated with that. But they're, especially if it's a pass-through regional dealer, they're not taking on any uncertainty there because there's a clear traded market for those 3-month securities. But now as they're starting to offer these in conjunction, with MCT and with Agile, as we're starting to add these further month executions out, the dealer is starting to take that risk, and I think that's really good because it gives you, the lender, another option to look at. This isn't something that you have to use, obviously, and Andrew will go through kind of how this, how this really works. But at the end of the day, you're going to analyze, what the role is versus, what potentially some of your other executions are, like a forward.
Yeah, and I mean, kind of how it works in the system is there's some needed communication to open up the flexibility with the dealer. So the dealer is going to say, okay, well, we're going to allow you as a lender to go out to this 4th month electronically, and then so that that setting will get updated in the database, and once that's good to go, then you'll now have the option to go ahead and make that trade with the dealer. So it really is a communication between you and the dealer on getting that set up, and then once everything is kind of in line and you've kind of met I guess the dealer and you have agreed upon having that additional flexibility, then we just open it up in our system for the electronic capacity to make it happen. I think the other day I actually was working with one of the traders, and we were able to get a 5th month settlement through for one of our lenders. So there is that functionality that we have built in, and it's going to either allow or restrict that capacity based off of those relationships that you have with the dealers. So we're still working on rolling this out to more and more lenders, more and more dealers, and like I said, I think that the future, as I see it, is kind of just opening it up and allowing more accessibility to this functionality.
And and just kind of future use cases. I'll not to give everybody whiplash here going back and forth slides, but this first bullet point of a future use case for indications, you can see we talk about a future limit order functionality, and actually that you see that button that's in there, add agile limit order. And so a limit order is a little bit different than a market order, and we're right up on time here. But basically, it's in certain real choppy markets, especially in the morning. Maybe if it's something that you want to get it's an uncertain market around an economic number, and for whatever reason, you as the capital markets director, you want to get a trade on, you can specify a price that if you want to get the trade on at a specific price, you can specify that price, and there's a certain time duration component that the dealer has to actually fill that, or what's called, or let it die, and then you have the ability to fill or kill that position. But look, normally on these on webinars like this, we don't kind of showcase some of our specific functionality, but we are really excited about the transparency and efficiency that this is bringing to the market, given some of the issues that we're seeing, right, with liquidity, and some of the new, to Kelly's question, some of the new kind of demands that are coming on lenders from a big portion of the purchase market right now, which is builders. So like Andrew said, we're really excited. I think the fourth month is going to be a big add, and like Andrew said, that it seems that he's getting good traction with some of the dealers to go out 5 and 6 months, and so we'll definitely come back to you guys later with that. I know we're over time here. Looks like we have a couple questions from some clients, and we'll get back to you guys specifically on those. But Andrew, unless you have anything else, I really appreciate everyone's time.
No, nothing else for me, and appreciate everybody else's time as well.
Thanks a lot, guys, and we'll be back to you. Hopefully not too soon with a big emergency, but we'll definitely be back to you with future functionality. Thanks a lot.